Welcome to Financial Minds Meet the Experts. I'm Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Returning today are Tim Sustak, SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. Today, we are going to get their opinions ahead of the upcoming FOMC meeting. Tim, I'm going to kick it off with you today. What's the current economic backdrop going into this meeting around inflation, GDP growth, and unemployment?
So that's a big question. I think, in a nutshell, I think, backdrop's still pretty good. I mean, I think you can make a general argument. Certainly the economy's probably slowed some since last year, but I think overall, you look at the numbers, things seem to still be in pretty good shape as of now. Talking about inflation, some of the recent statistics, we this past week got June CPI, so headline number came out at 2.7%, just above consensus at 2.6. Core ex food and energy at 2.9%, right on consensus. That was followed up by the producer price index PPI numbers. The headline number there 2.3% versus a consensus of 2.5, and ex food and energy 2.6, right on consensus. Inflation, while not yet at the committee's goal of 2%, isn't far off. And, we haven't seen a lot of tariff-induced effects yet. I mean, there's been some price increases, certainly, but that big specter of, inflation's gonna really take off hasn't happened yet. I mean, we'll see. As far as the job picture goes, recent jobless claims numbers came in at 221 versus 233 consensus, so better than what the markets were expecting. Non-farm payrolls, we've seen them about 140K averages for the past quarter, came in at 147,000 for June. So economy is still creating jobs. GDP is kind of a wonky one, to use a technical term right now, especially for first quarter. We came off at 2.4% in the fourth quarter of 24. We showed a 0.5% drop for the first quarter, but that was really due to all the import activity that took place, people trying to get ahead of the tariffs. So I don't know that has a whole lot of worth as far as really telling how the economy is performing. So recent retail sales numbers were good. So that's always a positive. I think right now, you've got this black cloud of what is going to happen with tariffs. And is there going to be some, really strong tariff-induced inflation? I think most economists would say they expect to see some. How much, we just don't know. It really hasn't shown up to a scary level yet, but we'll see. I mean, that's, in Chair Powell's last press conference, he kind of, took the time period of the summer and said, look, he thinks the summer months will be a good indicator of what will actually happen with tariffs. So, we'll wait and see. But I think right now, generally pretty good shape.
Okay. All right. Well, I mean, the two of you have been telling us, for months, the Fed's goal is 2% inflation target. So, Scott, how close are we to the Fed's 2% inflation target? And how might that influence the committee's decision next week?
Yeah, so we are getting closer. We're in the 2% range, but on the higher, mid to higher end of the 2%, depending on what reading you look at. So when you look at inflation, there's three main areas that we look at in the markets. We look at CPI, we look at PPI. So CPI is consumer price index, PPI is producer price index. So what the producers of finished goods, final goods are seeing inflation-wise. And then we have the PCE deflator, which is the Fed's kind of preferred method. They look at the core PCE deflator. That's kind of that's the one they key in on. And when you look at the last reading for all of those, they're in the 2% range. So core, and I'm looking at the core of all these. The core PCE, 2.7%, but it was up this past month. So we had been heading lower this past month. The overall was up. We were flat for the month, but actually the overall reading was 10th higher. The core CPI was, again, it was the same thing. It was higher this month on the core reading at 2.9%. So getting further away from that 2% target, and I say 2%, right? It's 2.0% is the Fed's target. It's not 2 point anything, it's 2.0. So that's really what the key is. We're in that 2 range, but we're not at 2.0. And then the other one is the core PPI reading was, it was lower, but it was 2.6%. So that's the best, but really that's the one that we look at the least because that doesn't give us an indication of what we as consumers are paying. That's really the producers. And really the issue is once the product is made and put on the shelf or put in the lot or whatever, what are we paying for it as consumers? So the real issue there is we're way off the highs of inflation. We've been trending lower, but we've been kind of treading water here. We were on a downward trajectory, and then Trump's tariffs caused a lot of concern in the marketplace of inflation heading higher. While we've seen a slight upticks, we haven't really seen anything major yet. So that's what the Fed has been doing, waiting to see what happens. And Tim alluded to that in his talks. The New York Fed president, John Williams, he was out this week saying that he still wants to wait and see what's going to happen with inflation. Tim threw out there, the summer months, they're probably going to give it 3 or 4 months of data to come in to see what it's going to look at like. But so far, the impacts of tariffs on inflation have been really minor to non-existent is what I would say. It's really been a little bit surprising. We thought we might, or the markets thought we might have seen some higher increases by now with inflation. So I don't think it's going to have much of an impact on them at this next meeting because it hasn't really done much of anything. It hasn't headed lower. If we were lower, there might be some incentive for the Fed to say, okay, maybe we should consider it. But because it's been relatively flat or a tenth higher, there's no reason for them to move based on the inflation data. So I don't think that we'll see any impact of that on their decision.
Okay. All right. Well, both of you kind of mentioned Trump a little bit. So, Tim, how much political pressure is the Fed under? And could that influence decisions, even if indirectly?
That's a good one. So I guess I would say this. Kind of the stock answer is there's absolutely no political influence, right? The Fed is designed and operates without political influence for a reason, right? They've got 2 mandates from Congress. Now, stable prices and full employment. And they look at the data and they make a decision based on reaching those 2 directives, right? And politics has no has no bearing on that, has no place in that. And that's what you'll always hear, right? And then, in my opinion, that's the way it should be. We're all human beings, right? I mean, I'm not inside anybody's head at the Fed. So does it play any role? I mean, I don't know. I mean, it's tough to say that as a human being, you're completely insulated against all of that, right? Who knows? But I think the Fed and the folks that are there making the decisions understand the importance of that independence and do everything they humanly can to not let the political landscape affect what their decisions are. Look, this isn't new, right? I mean, throughout history of the Fed, politics has tried to influence what they've done in one fashion or another, So I don't think this is anything new. I mean, I think maybe right now we've kind of gotten to a point where it has at times kind of degenerated into kind of personal attacks and things like that. And, my opinion would be that if you are trying to influence what they're doing, that might actually have the opposite influence, right? I don't know. I guess that would depend on the person, but I'm going to say I think generally it doesn't have an effect on what they do. I think they are, steadfast in the thought of, look, we need to make decisions that are best for the economy. We want to make sure that we retain our credibility as inflation fighters, because that's always the worry, right? I mean, the administration is going to be at odds with the Fed because they're going to want lower rates to keep the economy booming, even if it's detrimental, right, through higher inflation. So for the Fed to have credibility as an inflation fighter, they need to stay politically independent. And I think they've shown that here, right? I mean, Fed's been getting beat up pretty good as of late, and they've stayed the course. So I'm feeling pretty good at this point that the Fed remains independent, and I certainly hope that that remains that. I think most people hope that it would remain that way.
Absolutely. So, Scott, is the Fed expected to change interest rates at next week's meeting? Why or why not?
Yeah, that is an emphatic no. The Fed, it would be a major shock if the Fed moved rates at the next meeting here. It's so beyond unlikely. It's not going to happen. The Fed's not going to cut rates unless between today and then there's some absolutely crazy thing in the economy that happens. But no, there's no incentive for them to cut rates, which, by the way, is still their bias, right? Is to cut rates. There's no incentive for the cut rates right now. There's the data, as Tim talked about in the very beginning here, has been holding up pretty steady. When you look at everything in the economy still seems to be chugging along at a pretty decent clip. Inflation is not out of control, but it's certainly not at the Fed's 2% target. So they're not going to move at this next meeting. They'll sit tight. Now, what they could do is they could they could change their statement again a little bit to get us prepared for rate cuts in the future. They could say the bias is a little more, towards needing to cut rates sooner rather than later or something like that. But even that isn't super likely. But yeah, certainly no rate cuts coming at this meeting. And maybe a couple of meetings before we see rate cuts this year. When you look at Fed fund futures, they're basically saying the next two meetings. So there's one in mid-September. Also, it would be the next meeting after this July one. Less than maybe a 50% chance that there might be a rate cut there. We don't see 100% odds of a rate cut in Fed fund futures until you get to the October 29th meeting. So if we do see rate cuts, the markets are anticipating them later in the year. Tim was talking about the political pressure. Certainly there's a lot of pressure from the White House for the Fed to cut rates. They want rate cuts. Trump, he's not shy about speaking his mind about rate cuts and amongst other things. So he's certainly been pushing those. I'm with Tim had mentioned that, maybe that has the opposite impact at the Fed. And maybe it's like, what? We'll just dig into the information, and there's plenty of it out there to say we don't need to cut rates and we'll just sit tight. And I'm not saying that's happening, but it's kind of a human nature type of thing, right? When, the whole you catch more bees with honey type of thing, or whatever that saying is, right? Being nice and sweet to people usually ends with better outcomes than when you're not nice. And when you're in this case are telling Chairman Powell that, we don't want you there. We want you to resign. We want to replace you with somebody that's going to be more in our camp that will be in the rate cutting, more inclined to cut rates kind of thing. So who knows what they're thinking, but yeah, no rate cuts at this meeting, still sitting tight to see what the data shows over the next, 2 or 3 months.
Okay. Well, that kind of leads me to my next question. Tim, what signals, has the Fed given about the possibility of rate cuts later this year? Or what should we be listening to in the commentary after the meeting to kind of give us some insight there?
Yeah, well, I think there's a number of things, Jamie. So in June, we got their latest summary of economic projections, the SEP as they call it. And I think we probably all know that the dot plot showed two expected 25 basis point rate cuts this year. So that's kind of the first indication that's still, overall what the Fed is thinking. We've had some good commentary out there, and Scott mentioned some of this in his previous talks. Recently, Mary Daly, San Francisco Fed president, came out and said she thought that it was completely reasonable that we see 2 cuts before the end of the year. Christopher Waller, Fed governor, has come out, and he's actually was calling for maybe a rate cut as soon as this meeting, the next meeting in July. He feels that private payrolls haven't been doing as well, and wants to get out ahead of any damage to the job market. But then you have folks on the other side, as Scott mentioned. John Williams, New York Fed president, came out and said, believes policy is in a good place, and seems like he's certainly in the camp of let's wait a while and see. Raphael Bostic, Atlanta's Fed president, came out kind of with the same thing that, hey, I think it's good to sit and wait and watch type of thing. So I think right now you have a bit of a divided Fed, and the dot plot showed that, even though it showed the consensus of the 225 base point rate cuts. You had, I have this written down here, 8 of the 19 that put in projections for the SEP were looking for 2 cuts, and 7 of 19 saw no cuts. So, you have a bit of a division there. So which side is going to win out? Hard to say, but as of right now, I think, the 2 rate cuts that are expected certainly are not unreasonable, and at least, half of the economic projectors at the Fed feel that way too. So, as Scott said, we'll kind of see how the data shapes up.
Okay. All right. What global risks like geopolitical tensions or energy prices, could that impact the Fed's outlook? Scott, I'll throw that one at you.
Yeah, it could. What I'll say on the geopolitical risk side of things, especially if we're talking about the two major global conflicts that have been going on for, I don't know, a year and a half, 2 years now, the Middle East and then in Russia, Ukraine. I think since the bombing in Iran that we carried out, things have been kind of quieted down in the Middle East a little bit. The tensions seem like they've not evaporated completely, but they've lessened, at least from the market's perspective. The markets are a lot less concerned with these geopolitical risks than they were a few months ago. I would say Russia maybe is a little more. The Russia-Ukraine conflict is probably more in the forefront today because they continue to it seems like they continue to escalate. They're crossing lines that maybe we thought they wouldn't. But I think I had read earlier this week that Trump kind of had threatened tariffs on Russia if they didn't have a ceasefire by a certain date. Now, whether that works or not, I don't know. Who knows on the political sphere if that carries any weight? But there's certainly a push to end that conflict, get a ceasefire over there. I mean, we're still sending weapons over there, as is Europe, to help Ukraine in this war. But I don't know that either side has made a lot of progress in a number of months. So it seems like on the ground, maybe it's a stalemate. So maybe at some point they come to, cooler heads prevail. But it doesn't seem like either one of those is really worrying in the markets right now. And I would say the Fed too. Now, certainly both have the potential to escalate from here, but it looks like we're probably on the downward trajectory. The hope is we are. The energy side is probably more so of an issue. If we started to see higher oil prices, that would be a concern. But based on what we're seeing today, it doesn't seem very likely. With things cooling a little bit in the Middle East, I read recently, OPEC has their kind of targets that they set as far as how many barrels of oil they produce. And Saudi Arabia last month exceeded their target. And they kind of are the big boy, right? They control the OPEC and the quotas really more than anybody else. So they don't generally go over their quotas. And partly, I think it might be with Trump in office, he has this, what is his saying, pump, baby, pump. He wants to open up oil in the U.S. And we are the biggest producer out there. He wants to open up even more. So if you have competition or potential competition, more competition coming, what do? If you can lower prices, you might keep some of these folks out of the market because all of a sudden, let's say they need $60 a barrel to make this particular site work because, we're using a lot of technology, right, to pump this oil. It's not easy drilling and it's expensive. So they've got this baseline price that they have to meet to make it work. So Saudi Arabia is over there fearing competition. An easy thing to do is, pump more oil, cause oil prices to go down a little bit, and maybe keep some of that future competition out of the marketplace, or at least for a while, delay their entrance. So there may be some of that going on too. But the good news is oil prices have come down and have been pretty low. I was out yesterday getting gas, and for whatever reason, my end of town is a little more pricey than other parts of town because there's not as much competition. So it was $3 a gallon, $2.99. You frequently go to Costco though, and it was in the 260 range. I didn't go to Costco because it's a little up down the road, but pretty cheap gas right now. So as long as oil doesn't get out of control, and it's showing no signs at all of doing that anytime soon, then I think the Fed is pretty comfortable geopolitically and from that perspective too. So probably very little impact right now on the Fed.
Okay. All right. So Tim, Is the Fed at risk of holding rates too high for too long? What are the dangers of over tightening?
Yeah, I mean, they certainly are, Jamie. I think that's always a risk with monetary policy, right? That you're not quick enough to make a move. The risk of holding rates too high too long is you squash the economy, right? You dampen growth, you hurt jobs. And I think that was one of the points that Fed Governor Waller was making is, he's seeing the private sector. He doesn't believe that that's as strong on the employment side as other people think. And he would like to get out ahead of that a little bit and start cutting rates so we don't you know, see, issues there. And that is always the game. The Fed is kind of paid to anticipate, right? And you hear them talk about this a lot, where they say, 2%, like Scott said, 2.0% is the goal. You can't wait till you get to 2.0% to start, cutting back on rates because you overshoot and you do too much damage. And, I think that's what, they've been criticized for that. Certainly, it's one of the criticisms of the recent Fed is that they've been, late at times to do things. And, we'll see this time, how that plays out. You usually don't know until you're a little beyond and see what the effects are. But you're right. Certainly they can hold rates for too long. And what we'll see it do damage to the economy. So hopefully that does not happen, but we'll see.
So, Scott, how might the Fed's next steps impact mortgages, auto loans, and rates at credit unions?
Yeah, so those are big things, right? When you look at the latest quarterly call report data, it's home equity loans have done well, but when you look at mortgages, first mortgages, whether it's refinancing activity or just home purchases, um, have not been good at all. Firsts have been really a struggle, and not just for credit unions, for everybody, because rates have remained pretty high to borrow on a mortgage. And the same goes with autos. There's definitely been a slowdown across the U.S. with auto lending. So uh, certainly, if the Fed were to cut rates, which again, that is their bias, is to cut rates still. It's just when is this going to happen? But it'll certainly help. If the Fed starts cutting rate and the yield curve follows suit and kind of is a normal shaped yield curve, and we see a shift down across the board, for instance the 10-year goes down too, then we will certainly feel better about home sales, and credit unions' ability to do mortgages, first mortgages. It's really been really slow out there for home sales. There's two in my neighborhood that are for sale right now. They haven't been on the market too long, maybe a couple of weeks, but if rates were normal, I would suspect those houses would have, I say normal. If rates were lower, not normal, because I think we are in this normal range. The new normal that we got used to during and post financial crisis when rates were really low. And I'm not saying back to sub 3%, but I'm saying if we got into that sub 6% range, so, maybe 5.5 to 6%, I think we'd see a lot more activity on the mortgage side. But it's going to take some time to get there. And most think we're probably not even going to get there this year. And it's partly the Fed, right, cutting rates, but it's partly our fiscal situation in the U.S. where we have this really large debt burden that continues to grow, and the Treasury has to continue to issue debt. And is the U.S. still good? I think we talked about this maybe in the last one or two podcasts ago when Tim was talking about the ratings of the U.S. that had been lowered by, I think Moody's was the most recent one. But in any event, that it's one of those things where has an impact too. But if the Fed cut rates, it would certainly help the economy, would help people feel better about the funds that they have to spend. And then when the rates are lower, that certainly has an impact. Think about how many of us have these lower mortgage rates from 2 or 3 or a few years ago when we refinanced with lower rates. We have excess cash in our pocket today because we maybe refinance it, under 4% versus 6.5 to 7% today. It takes more money out of your pocket. So it gives us more flexibility to spend. And we would see the same thing with the consumer. So it would be a net positive for credit unions if we could get that yield curve to shift lower. And the Fed would certainly plays a role in that.
All right. Well, thank you both again for joining me. Tim, any final thoughts for our listeners today?
I guess I would just say, I mean, there's just so much information out there right now that we're being bombarded with, and there's so much uncertainty. I would just say, we're all paid to manage money, right, in one way, shape, or form. and you kind of have to be agnostic to either side when you're doing that, right? Because there's probably some truth and some guidance in what everybody says, and I think we just have to kind of listen to what everybody's saying. Certainly listen to the Fed. They're the ones make the decisions on monetary policy. Listen to what the Fed governors are saying, the Fed bank presidents are saying, and take pieces that you believe are true from everybody. Come up with your strategy because I'm not sure anybody really knows what's going to happen from here on out. And I think if you did, you'd be retired. So.
All right. Well, thank you both for joining me today. Really appreciate it. This episode of Financial Minds is brought to you by Vizo Financial's partner, Know Before. The more practice and emphasis you put into security awareness, the better you'll be able to deal with social engineering threats like phishing, vishing, and cyber attacks. This is why Vizo Financial has partnered with an industry leader, Know Before. Their platform uses simulated social engineering testing and security awareness training to help your staff get practice at identifying these threats. By utilizing the same tactics cyber criminals might leverage to gain access to your credit union, this service can help you gauge your level of risk within your institution and adjust your security awareness training accordingly. Make security awareness a top priority at your credit union with Know Before social engineering testing services. To learn more, visit Vizo Financial's website at www.vfccu.org. Thanks for listening and make it a great day.